Welcome back to another episode of Fast Casual Nation, the podcast. And of course, as you guys know, this is the show that breaks down all things in the fast casual business. In this restaurant industry right now, if you look at this category, it's almost $60 billion, and it's made up of a ton of emerging companies. And we're going to analyze some interesting stock moves that are happening with an expert right here from South Florida, Mr. Andrew Horowitz. Great to have you on the show, man.
Hey, thanks a lot. Listen, when you first sent me an email and said burgers with a question mark, I was like, hey, we're going out. What are we doing?
There you go.
Glad to be talking about that category.
Listen, Andrew, there's a ton of movement happening in the space right now in the market when you look at these players. The restaurant stocks in their own right have had some ups and downs. Chipotle's made some nice little comebacks. Shake Shack has wobbled a bit. But we have a South Florida player that is looking to be entering the game, and that is BurgerFi.
Yep.
What is your thoughts on this? Let's talk a little bit about kind of this company that I know it's still an agreement right now. It's an agreement in place that they're going to do an acquisition or some sort of merger. What's the play here?
So, I mean, it's a letter of intent right now from a SPAC, and this is a new way of, I would say, doing a move into the market without going through the entire IPO process. So what you do is there's companies out there. In the old days, they were called either blind pools or something of that nature. And these days, they're called SPAC, Special Purpose Acquisition Companies. We've seen this before in a couple different things with DraftKings, with Virgin Galactic, for example. There's a few others that are out there. And basically what happens is this company will create the entire process and then bring in a company. And sometimes they do very well. As a matter of fact, it was up pretty well when the announcement came that BurgerFi was going to be going through this process. And essentially what it is just a backdoor way of getting a company out there to IPO. So right now, the symbol is ORES. It's probably going to change to, I don't know, BFI or something like that.
Yeah, right.
Or Delish or something of that nature. But basically, all it is right now is a letter of intent. There's not a lot of information because it's a privately held company that'll be brought in here. But it is looking like it's going through the process of at least getting to the market to become public.
What would be the advantage of a company like BurgerFi going this route as opposed to the traditional IPO track?
So the traditional IPO track is oftentimes, first of all, it's a lot more expensive. There's a lot more people to cut in. You're cutting in the major players, the Goldmans, the Morgan Stanleys, the Merrill Lynches in the deals. That's first of all. Second of all, a lot more scrutiny. You have to do all sorts of paperwork to get this thing done, right? Versus
due diligence.
Yeah, the due diligence is zero. I mean, there's nothing to it. You basically, there's some, but you basically put it in there and then it just floats out and you have the company already on the markets, already done. So you don't have to go through the whole pricing process, the distribution process, the pieces of the deal that get cut out by the major players. There's a couple of different ways of doing this. It's a very smart way to do it. It's also usually smaller companies that do something like this. They're not necessarily looking to raise capital in this at that level because it's at the same levels, right? So it's going in there, it's going to have stock, and everybody's hopefully going to profit from it, but maybe not from the ground to zero to where it is. Maybe they're taking a piece off it at $10 already and getting in at that point. So there's different ways of doing it, but essentially it's just an easier, maybe a less expensive way of doing it, less scrutiny.
Yeah, interesting. So if you look at some companies recently that have gone public, some have actually gone out into the market without going through the traditional investment bankers. Why wouldn't they have taken maybe a self-listing approach as opposed to going this SPAC route? I'm still perplexed about this.
It's just one of the things in the market today that people are doing. There's Dutch auctions that we saw years ago by a lot of technology companies that didn't want to go through the same process, supposedly making it fairer for the investor out there. Just another way to get to market without scrutiny, especially at a time like now, where you're looking at a fast food company that maybe is having some difficulty in their revenue stream as well as their earnings, and it's just much easier is all.
Interesting. All right, well, let's look at kind of a comparison because there's been some recent moves. Of course, with Yum, they purchased Habit Burger last year. Habit, of course, has kind of been up and down. What are your thoughts on Habit? I know you sent me a ton of stats on some of these. This is what you sent me. Yeah. There's like 40 pages here.
Right.
So let's talk
that's
about.
pretty amazing. That's pretty amazing to begin with. That many potential companies that are either burger related or somewhat in that genre.
Yeah, exactly. So with Habit, their acquisition, and of course, they made an interesting move, and I think one of the things that helped their stock price spike a little bit was their mention of Impossible being their new plant-based burger, which Yum actually released the press release about it, kind of trumping that up, so to speak. What are your thoughts on whether or not Habit and Yum have got a good marriage going on here?
Yum needs to have something because, I mean, if we look at Yum, we look at, first of all, has a lot of debt. There is a lot of debt with that company. Yum is also a major player in Asia. So this is to get the footprint of the, I call it fake meat, whatever you want to exactly call it, vegetable-based, plant-based burgers into that environment. And obviously looking to expand from the Kentucky Fried Chicken and the chicken-based, which they have throughout Asia and US as well, but there's a lot going on there. But they've seen a lot of competition recently. Look at what happened with Popeyes, for example, a QSR brand that really went head to head with them in the chicken. Everybody's talking chicken, right? For the longest time, everybody's talking chicken. Now everybody's talking, plant-based. So I'm not a big fan of the plant-based. That's me personally. I've tried a few of them and not satisfied. But nonetheless, it is something that is really getting the market's attention. Remember, these are companies that are looking to gain market share. It's all about making sure that their name and their brand continues. So I think this was an acquisition for spreading out the brand, if you will, and the underlying style of what they do, as well as then having an easy way to then introduce it to other markets.
Yeah. Well, and the argument I've had often with, major acquisition, and if you look at the history of fast casual brands that have been acquired, you can go all the way back to Baja Fresh, which was acquired by Wendy's, who was a QSR brand. They struggle with getting Baja Fresh kind of in position. That brand has been devalued and almost, non-existent anymore. And we've seen things like Qdoba. Qdoba was the same scenario, got acquired. These kinds of acquisitions with a QSR brand usually gobbling up a fast casual, which are usually, if you look in the case of Yum, they're a giant. Habit was a very small player at the time. Right. And at least in fast casual, you have very clear delineation between the two types of concepts.
Right.
Usually the product is higher in quality, and the price point is higher. And usually the way that you go in and get the restaurant or get the product at the restaurant is considerably different than you would when you walk into a McDonald's. So in most cases, my argument is that the operational tactics of a QSR often don't align well with a fast casual.
Right.
So it's always a question mark. That's why I'm interested in the BurgerFi, because this obviously is just a financial vehicle that they're going to be able to funnel in and get out there and compete with the likes of Shake Shack.
Right.
I guess the question would be is, looking at QSRs, do you think this is really a good play, even though there is some, a little bit of a blueprint out there right now for them to go after these fast casuals? Because there's a lot of players that could.
A good play for BurgerFi, you mean?
Well, no, a good play for QSR brands to go do another another acquisition like Habit.
Oh, I got you.
That's the fast casuals that are out there that could play into that market.
I'm not a big fan of some of these. I think there's way too many of these out there, by the way. I mean, seriously, if you just had a show dedicated to taste testing burgers around South Florida, you would fill up plenty of time, right? Am I right?
Yep,
so,
you would. Yep.
So, and there's this, single stand operations, there's the bigger ones. I mean, there's some great ones up in Pompano and Miami and West Palm and Fort Lauderdale's a couple. But the fact is that I think that it's been overdone. I mean, just how many hamburgers can people eat? I get it. It's a love. It's an American favorite. It's wonderful. Just a full disclosure, we're, as a firm, short Shake Shack, meaning we are betting that the stock is going to go down, and it has gone down. It's not the first time we've been in that camp. Very rarely are we going long. Listen, the management of the firm is good. I like the idea, but the problem is that I think there's just too much competition. I think that possibly the Yum acquisition here and trying to spread their styles of what they're doing is probably good. However, again, I just don't see that this is a sustainable model necessarily as a standalone either, which is probably why Habit was looking and agreed to doing this, where now that Yum will have the opportunity to have another source of revenue, And don't forget something. There's a lot of in some of these, the margin can be pretty good in the burger area.
Well, if you can get to the right markets. I mean, if you could imagine if In-N-Out ever, positioned themselves either for an acquisition or a position to go public.
Or just came to the East Coast.
Well, true. That is true. All right. So Beyond Meat. So this was an interesting chart you sent to me, and that was the total return price percentage. And Beyond Meat is the one out of all of these that is winning big right now, where all of the burger players, whether you're looking at McDonald's, Wendy's, Shake Shack, Restaurant Brands International, and Yum, all pretty much kind of neck and neck in terms of their performance here recently.
Yep.
I mean, Beyond Meat, slow rise.
Yeah, Beyond Meat, the problem is, it's a very volatile stock. It's very thinly traded. It's a bit of a cult stock. Here's a couple of things you need to know about it. It's a bit ahead of itself. The PE ratio, which is the price to earnings ratio, is 211. Right. Price to sales is 23, down 40% off of 52-week highs. This is interesting in that there is only right now in this plant-based meat alternative is what, two companies really?
It's just have them and Impossible, which Impossible hasn't gone public.
Impossible hasn't gone public. Impossible does have, of course, Burger King with the Impossible Burger. It's in a variety of stores as well. And there is some indication that many other companies, I think there was a couple of announcements last week or this week, that Impossible is going to be utilized in whatever particular chain. They're going to be looking to spread out to, we're talking sausages. We're talking about, there's companies right now that are trying to make fake eggs. Just eggs. They have the Just company. So that's a privately traded. But I think that when we look at Beyond Meats, it is a question of how much is going to really get itself into that. And if it does get into the mainstream of many of these players, how much is that going to then change the process of meats? In other words, are they going to cut down on their margins? Is it going to be an increase or decrease in margins? Is meat prices, are they going to go down because now all of a sudden we don't need all this meat, right? So we just saw that recent meat spike due to the coronavirus and the plants being shut down, the Smithfields, the Tysons, being shut down due to the spread. And that doesn't seem to be slowing down either. So we saw that big spike in prices. Meat prices, did come down substantially from then, but I do still wonder about the ability for many of these companies with these pea proteins and these, the various mung beans and plant-based types of products, if in fact it will be acceptable and a standard. That's what they're kind of thinking about. I just don't get it.
Yeah. Well, right now, the argument is that it's still a very small fraction of the market. It's a very expensive premium product. So, and many of these are going into some of these markets. And again, many people will argue that a lot of times it's a marketing move for companies like Burger King, Habit with with Yum and Habit, and what they're trying to do now with Impossible. That there's a lot.
But wait a minute. But the theory of the marketing is it's better for you, right? Have you ever looked at the ingredients?
Don't get me started on that.
It is not better for you. I don't know if it's worse for you, but I can't say with the salt content and all the other things that are in there if it's actually better for you. So this whole idea, yes, they bring it as a plant-based vegetable. And you think, I'm eating carrots and I'm eating celery, I'm eating peas, I'm eating, good things for me. Yams, it's delicious. No, it's not necessarily better for you.
Yeah, well, and I think the argument that most of those companies would make is it's an alternative to animal proteins.
Correct.
And of course, with animal welfare and that movement that's moving through the industry right now, that I think is what's keeping it alive more so than the actual product itself, because the product itself is probably just very close to what a burger would be. All right, let's talk, because Wendy's, of course, is one of those that seems to have a little bit of a sharper ascent since the mid-March.
Yep.
So they've been on the track. Why would Wendy's be looking so good right now versus someone like McDonald's, almost in the same position?
Well, what's interesting is I think Wendy's is a little bit tighter. There was a better, I think there was a better uptake overall in terms of how they were delivering during this process. Wendy's is 10% off its high. McDonald's off 15% of its high. Wendy's is a much richer stock. Wendy's is trading 31 times forward on a PE. Their price to sales is less than McDonald's. The price to sales is only 2.93. Their free cash flow is an issue there. That's a real problem with the stock. McDonald's, though, is trading at 23 times, 6.8 or so on price to sales. So McDonald's is trading a much higher level on a price to sales. In other words, the price compared to their revenue stream. I think that they're looking at Wendy's as a better margin play right now, and that's what came into this place here. That's all I can say.
Yeah. Interesting stuff with the big players. Let's talk and move away from burgers for a second and head over to the delivery category. Grubhub, of course, big news just this week, new acquisition from a European company. What are your thoughts on that? Because delivery has been, you would think, has been the darling, but this company looked a little bit frantic in their sale.
Yeah, I mean, Uber was looking to merge or acquire, and there was a bit of a fight. There was a pricing issue, and they went back and forth several times. Then the deal was off, and it was on. It was a real mess. It was a bit of a drama, I'll be honest with you. And then all of a sudden, Uber said, you know what? We're not paying those numbers. So what happened was this company out of Europe, out of England, came in and said, we think we could do a deal. It was a bit richer than the Uber deal. But it does look like if you boil this all down and take away all the drama and all that this was a frantic thing from the side of Grubhub that needed to be saved.
Yeah.
So
cash.
Yeah, they were running out, and again, it's pretty amazing in this environment that that's the case. Now, mind you, a lot of restaurants couldn't open in certain places, so I understand that. But still, you would think that if the restaurants aren't open, and in fact they didn't have drivers running, they didn't have that expense either of that side of it. You know what I'm saying? It was just a very weird situation that obviously management was very either poorly set up to do this, or I think as you and I have talked about, the model is basically broken.
Yeah. Well, that's the thing that I keep arguing is with delivery, meaning Uber, Grubhub, Postmates, et cetera. Even if you go down into the small guys like a Delivery Dudes here in South Florida, the model itself is a broken model because essentially your customer base is a company set that essentially has just a sliver of a profit margin. So there's no real room for them to take on expenses that you have like what you get with delivery. So eventually it was going to hit the wall anyway, and these companies were already losing money in this category for per delivery. I've heard Uber talk about this often, is that they lose money on every delivery through Uber Eats.
Right.
So if the logistics are really the important thing, and it's the thing I've argued often, is why have these companies not pivoted their business, meaning Uber, Grubhub, into a SaaS product? I mean, there's no longer 1 million restaurants out there, but let's say there's 700,000 that potentially would be your market play, and you're not 888 billion, now you're maybe 500 billion in the industry. But that's still a large chunk of the market, and they were still only hitting 2-3% of the market in terms of
It was very expensive for the restaurants, right?
Yeah, because of it's 25% in many cases.
Yeah.
So a SaaS product would be a logistics play that they could easily jump in and offer that as a service, versus a delivery service.
And that doesn't seem so hard to I don't think you're that far off, because really what we're talking about from all these companies, and this boils down to a lot of the companies that are out there that are doing this gig economy. It's really, it's not what it is in terms of the specialty of what they have. It's the technology that they've created, right? Isn't that true?
Yep, absolutely, 100%.
And the technology then you're saying can then be inserted rather than a standalone, kind of, we're using them, we're not using them. Their technology could be used. You pay a monthly fee or maybe even a per ticket fee or whatever it is about it coming in. The other players handle the websites, you have your menu online, all that, and it comes in, and then you dispatch your own drivers to then deliver.
Yeah.
Now, the only negative with that is this. Well, the only negative, there is one negative, right? How many drivers are you going to have on? Let's say you have two. Let's say you have two drivers.
Well, yeah, but the pizza guys have mastered this. Okay,
well, yeah, that's true.
They've
the
mastered
Chinese food
it.
Too.
And and they're not using the logistical products as much. They're definitely not as sophisticated as an Uber or even a Grubhub to a certain extent. I would say Uber, though, has the edge here if I was really looking at them pivoting and going to a SaaS product, because their logistics product is superior to probably anything out there in the marketplace. And if they made that available, just like they make it available to the drivers, you're a driver,
Right.
it'd be like instead of I'm a driver, I'm a restaurant using your logistics
Right.
product. And
Exactly.
you're a marketplace, meaning that Uber is still the marketplace. So as an operator, you can advertise on it, much like what they've done with Yelp in the past years. I just see this as a completely different. And in that kind of scenario, you remove the drivers completely out of the equation. There goes 70% of your cost right there as an operation from Uber, which means you're going to be able to offer this product, to more restaurants, and they're going to use it more. And
Actually, if you take this to the next degree, you would think that Uber should do the same thing for the taxi services and for the private cars.
Yeah, they could.
Because they're losing money. I mean, they're basically losing money on this, which is hard to believe that billions of dollars are being spent on this technology. But
it's a crazy one. I'm not a big Uber fan. I'm a big fan of what they've done. They just haven't been able to pivot, at least in the food industry, pivot in a position where they can make it available to restaurants. Because eventually the restaurant guys, I think, are going to figure out delivery just like the pizza guys already did. They're masters at it. I think the rest of the industry is going to get there. For sure. All right, one last thing on BurgerFi. If you're looking at this brand, this brand, obviously it's here in South Florida. What do you think about them? Do you think they have the potential to maybe start to go stride with someone like Shake Shack?
I mean, I think they do. I mean, it's the way I look at it is an overpriced burger for what it is. It's good though. It's quality. It's consistent. I don't really know a lot about the details about their overall finances because they're privately traded, of course.
Yep.
I mean, I can just tell you, fries are good, nice and crispy. Burgers are good, nice and greasy. I mean, and they have a nice. What do they do? They emblazon the top with a torch, or
like a brand.
Yeah, they brand the
The
top.
BurgerFi brand.
It's good. I mean, I think BurgerFi is good. It's not like, oh my gosh, their prices are better than a Shake Shack. I don't think they have those kind. I mean, a shake at Shake Shack is what, like $9 or something like crazy like that.
It's expensive.
Shake Shack is good. I would much rather White Castle go public. Just saying. Just saying.
White Castle. All right. Well, you heard it right there. White Castle is going to make its way to Wall Street, we hope. All right. So we're going to continue to cover more of these kind of topics here on Fast Casual Nation for sure. Andrew, thanks for stopping in on the show today.
Hey, thanks.
It's been great having you. All right, so you guys are listening in over on Spotify, maybe on iTunes. Make sure and drop us a note. That's how we get feedback from you. It's how we learn what you're interested in. Hopefully more conversations like this will be going on from time to time. We do bring brands on here, CEOs. If you have a fast casual concept that you think is the next power player, maybe it's time to send them our way. Just shoot us an email to producer@FoodableTV. And of course, you can always hit me up on Twitter @Paul Barron. We will catch you next time right here on Fast Casual Nation.